So good morning, everyone. I hope your day is going well. My name is Manuel Holguin. I am the business advisor for the Community Futures Entrepreneurs with Disability program in rural communities. While we join today virtually, I would like to acknowledge that I join you today from the Encla, Kapmok, and Sil territories, and this is in the Nicola Valley. So I want to welcome everyone. So I want to remind you also that we have through two programs here through the Community Features British Columbia. We have the EDP program that is here to assist people who are already operating a business, and we also have the IDEA program. The IDEA is a provincial program that we have to assist clients that have a business idea and they need assistance to start a business or to develop a business plan, for example. So in any case, many of my clients, they need to raise capital. And we need to talk about the different types of loans, the different types of credit. So, and that's why we have an expert here. So we have Anita Moore from the society, that's the Credit Counseling Society, and we are going to be answering all those questions. So when we are trying to raise capital for my clients, we also have to learn a little bit about your personal finances. So what are you bankable? You are not bankable. Are you in the position to increase your debt and all those details? So we are happy to have Anita here. Thank you so much, Anita, for being here, and we will be happy to answer any questions that you may have. So Anita will explain if we can take the questions at any time or at the end of the session. Please go ahead, Anita.
Thank you so much, Manuela, and thank you for having me, and thank you everybody for joining in this morning. My name is Anita Moore, and I'm a financial educator with the Credit Counseling Society. The Credit Counseling Society, in case you don't know too much about us, we are located in New Westminster. That's where our head office is, and we have been around since 1996. I've been with the Society for 17 and a half years, and previously I worked for a credit union for 24 years. So I've definitely got the background. So if you have questions, what we're going to do is you can put them in the chat or write them down, and we'll talk about them at the end. Alrighty, and I should be able to answer most of your questions, I'm hoping. So the Society, we help, we educate, we give hope, and you'll see the numbers, and you can take a look at our websites a little bit later. I will also send a copy of the presentation to Manuel in case you would like to have it, but with the recording, you might have everything on there, so you may not need it. I'm going to bypass that actually. So let's talk about our agenda. As Manuel said, we want to make sure that you know if your clients have a lot of debt, are they capable of borrowing money, what everything looks like. So here today, we're going to talk about what creditors are looking for when consumers are applying for credit. We're going to look at credit scores, and we're going to look at the different types of financing that's available. My objective today is by the end of the session, you'll be able to describe what creditors look at before making their decision, describe the difference between secured and unsecured credit, and understand the different various financing options that are available. So what is financing? So financing is the act of obtaining money from an outside source to purchase a good, a service, and it's usually with interest, unless you've got some really nice family. So next slide, why do we finance? All right, so let's take a look at why we finance. We finance things for purchases that are too large to pay with cash. So we need to finance them some way, and we'll make monthly payments on them so we can still afford to get that money to access whatever it is that we're doing. Is there a deal too good to pass up? That's a tricky one, isn't it? We can't afford it, but we want it anyway. And a deferred payment. Maybe that's why we're financing something, because we cannot have to pay for a year and a half or 2 years. And that's a good incentive, right? Maybe, maybe not. And how about to improve our credit? We all need to keep an eye on our credit. We'll talk about that. And we all want to make sure that if we've had just a slip where maybe we missed a payment or two, how we can improve our credit if your credit score has gone down. So what do creditors look for? Creditors are looking for something called the 5 C's. They're looking at your credit score, and they're looking at your debt ratio. So the 5 C's They're looking at character, and character is basically they're looking for stability. How long have you been at your current address? How long have you been in your current job? How do you pay your bills? They're looking for capacity. Do you have the capacity to take on more debt, to take on another payment? It's a lot of people that have a lot of money in their homes. They're equity rich because of the market, what it did. But that doesn't mean that they have the capacity to borrow more money because they may not be able to pay it back. Capital, your net worth. And to value your net worth, what you're going to want to do is take your assets and subtract your liabilities. That will give you your net worth. Collateral. Are you able to offer anything to this financial institution for collateral to guarantee that you're going to repay the loan back in terms of even a mortgage or a business loan? And conditions. What outside conditions might affect your borrower's financial situation and your ability to repay? I mean, look at COVID. A lot of things have happened since COVID. Businesses are struggling, and they're struggling because they can't get people to work, and they're struggling because the costs have gone higher with food. When they lost money during COVID, they had to bump their costs up, and it's all being passed on to us. So we have to make sure that when you're lending, or the creditors need to make sure that the conditions aren't going to affect you too much. So your credit score is it's a predictor of how you're going to repay your debts. It basically is a calculation of how you have been paying. Have you been paying your debts on time every month? How much money do you owe? Now, the lowest credit score we see is around in the 300s, 400s. The highest is 900. The average is mid 700s. Now, a lender in a financial institution is going to do their own calculation. So if you think that, like my son thought that, oh, mom, my score is 800. I can go in the bank, get an $80,000 truck because girls like trucks. I'm like, yeah, no, it's not going to happen. What do you mean it's not going to happen? Well, you know what? Just because you have a credit score of 800, number one, it doesn't mean that the bank's going to have a credit score of 800. And it doesn't mean you can afford the payments, because the financial institution cares a lot about your payment history, and they care a lot about how much is owing. They don't care how much the length of credit history you've got. They don't really care too much about the types of credit you have, but they do also care a little bit about the new credit. Have you been applying elsewhere for credit, and how often? So let's say, for example, you before you went to your bank to ask for a loan, you decided to get some more credit cards. So you applied for a credit card and they said, no, I'm sorry, you don't qualify. You've got some slow payments. And then you go, okay, well, I'll try somewhere else. I'll try somewhere else. Then you think, okay, well, it's not going to work. So I'm going to go to the bank and see if I can get a loan from the bank. So the bank pulls your credit history and they see all these new applications. Oh, how come you've been applying for all these credit cards? That's a red flag. So we have to be careful again with applying elsewhere, even if it's like a free hat at the sports event. Even if it's you walk into a store and they say, we'll give you 5% off your whole purchase right now if you apply for the card. Be careful, because that is a hit against your credit rating. Your payment history refers to whether or not you pay your debts on time, how long you've had these debts, and whether or not you've made any late payments, anything gone to collections. The amount owed refers to how much you already owe, the total amount owing, the percentage of credit that's still available to you. Because if you are carrying more than 60% of your total debt portfolio, if you owe more than 60%, that's going to start to bring your credit rating down. Okay, so it's really important that we remember to really try and get our cards paid off as soon as we can. All right. Now, debt servicing ratios. This goes back to talking about the capacity. do you have enough money in your budget to make a monthly payment? And basically what it looks like there is they will take your monthly housing costs and add the payments there. And sometimes that includes your hydro. Sometimes it includes, if you're paying a strata, 50% of strata. The important things that you have to pay, they're going to add that up and your debt payments and see how much is left for you to pay another loan or for you to live. Right now, mortgages, they're averaging about 32 to 35% of your gross family income. If you want to look, just try to, see, okay, if my mortgage is, or I want to look for a new house and it's $2,000, I'm going to divide that into my gross income. Now, you might make a lot of money. And if you make a lot of money, that might come out really low. It might come out to 20%, which is fine, but you may have a whole lot of other expenses that you have to cover. So again, people who are equity rich and cash poor, they have a lot of money in their house, but it doesn't mean they can afford a payment. Now, there's tons of different ways to finance, but all of them will either be secured or unsecured. And some are limited to only secured financing, but others could be secured or unsecured, and there's different pros and cons to each one. So when we look at secured financing, when we look at secured financing, that is money that you've borrowed and it's secured to an asset. So that might be something like a car, something like a house. Less risk to the lender. The lender can take the asset back and sell it to pay off some of the debt or all of the debt. That would be like a foreclosure on a home or a repossession of a vehicle. So if you miss payments and you get far enough behind, they will take that asset. Unsecured basically is the opposite. They're lending you money on your word. It's your promise to pay. That's why there's so much involvement and so much background work and legwork to see if you are able to lend somebody some money in a finance world, because they have to make sure if they're lending it to you without any collateral at all, that they're not taking a risk. And if it is unsecured, it's subject to legal action if you don't pay it. Now, an installment loan. Now, we have to really be careful when it comes to insurance on installment loans. Now, some creditors, some lenders are legally required to offer you insurance, but you are not legally required to purchase it. All right, there's a difference there. The lender is legally responsible to offer it to you. All right, but you don't have to take it. And think about, why would I like to purchase it? Is it a comfort decision that knowing if something happens to me, that debt is paid off? Is it security, safety? Is it necessary? Do you have other insurance available that if you have other insurance that it would take care of it if something happened? And is it cost effective? Are there any other insurance providers that you could ask or you could consider about insuring it? But some lenders, again, will ask you to take it and you do not have to take it. Now, vehicle leasing and buying, this is a tough one because it kind of goes in stages with leases and buying. Normally, people who lease a vehicle are companies. They're companies that maybe have to change their vehicles every 5 years. It's a requirement of that company. So they lease a vehicle, which means that the company and the lease creditor own the vehicle. You're just making payments to it. And then you return the vehicle after the 5 years, and then you get a new vehicle. Okay. Now, the advantages of leasing is every 5 years you get a new vehicle. Okay. If you're self-employed and you're required to travel for work without compensation, you can maybe write off some or all of the lease payment. And leasing a vehicle can be considered a tax deduction. You got to talk to your accountant, bookkeeper to see if they know what that's all about. And getting that new vehicle again, you can get more money for the monthly price. But remember, a lease is there to reduce your monthly payments. And then at the end, quite often, you have a balloon payment is what it's called, that you have to pay at the end because instead of paying $500 a month, you chose to pay $300 a month. So where's that other $200 going? Somebody's got to pay it. The balance of your lease is not going down. Okay. You are also going to be required to do regular maintenance, usually by the car lot. Okay, and that can be really expensive. There's two different leases that are out there. One is called a true lease, one is called a security lease. A true lease is where the lease has the lump sum that you're going to pay out at the end of the contract. That keeps your payments low. Okay. It also is the type of lease that in a regular, when we talked about, pardon me, a vehicle repossession, that is a true lease is not a security lease, is not the type that they can repossess the vehicle. But if it's like a car loan lease that maybe, let's say, maybe the car lot decided to finance your loan over 8 years, and then you're going to make smaller payments for 5, and then they're going to bump your payments right high. That's called a security lease. You own that car. Okay, so they can come and take it if you don't pay. The other one is where the company basically owns the car. The advantages of new vehicles, there's less maintenance. Sometimes that's not so true so much right now. Warranty, lower financing rates are available. And the advantage for the used vehicle, lower price and slower depreciation. But right now, it's kind of like our whole world is turned upside down, because I personally know somebody that last April, May, ordered a vehicle, and it was to be delivered in July. And they had to wait for it, and it's like, okay, and it was brand new. Come October, last month, they said, the price of your vehicle has gone up $15,000 because the cost of parts has gone up. The cost of shipping your vehicle over here has gone up. He said, then cancel it. I don't want it. So a lot of things are different. And now people don't want to buy new. So what are they buying? They are buying used. But used vehicles are being sold for prices we've never seen before. If you need a used vehicle, try and talk to family, friends, anybody out there, and see what you can do with it rather than getting into a large loan for a newer vehicle that's automatically going to drop the minute you drive it off the lot. The value of it's going to drop at least 10%. A rolled over loan is a loan that they're going to keep rolling over, meaning, remember I said, if you're going to pay a lower payment, maybe it's going to be, they'll say, we'll do it over 8 years. Over at 5 years, they might roll that loan over. So when they roll the loan over, it means that you're extending the payout period. So now you may have a vehicle that's 5 years old. They're going to roll that loan over, say, for another 5 years so you can afford it. So now at the end, you're going to have a vehicle that's 10 years old. Worse yet, you're going to be paying for that vehicle for 10 years. What would that look like? That's a heavy burden to carry. And how much are you going to end up spending in the long run? Ask them, how long will it take to pay it off and how much you will be paying in the long run? Mortgages. A mortgage is a debt, again, that is an asset, and it is secured to your home. When the mortgage is paid off, you will get your title to your home that states that you no longer have a mortgage. This home is yours. But until that time, the company who gave you the mortgage owns your home. Okay? A CMHC mortgage is called a Canada Mortgage and Housing Corporation mortgage. It is government backed, and it is only available to homes with a purchase price of over $1 million. Maybe that's got something to do with why home prices are so high. High ratio mortgage, that's what the CMHC is. It's a high ratio mortgage. If you can't come up with the down payment, then you're going to require to get the insurance. And the insurance is normally if you're less than 20%, and you can pay it up as a lump sum, but it can be extremely high. You will also be subject to a stress test. And what that stress test is, and actually, we have to be thankful. A lot of people have to be thankful that a lot of financial institutions did the stress test, because, say, 5 years ago, 7 years ago, everybody was getting into mortgages at low rates. And me I've been a previous lender, I was in the credit union system for so long, I'm going, oh my gosh, people are borrowing money at 1%, 1.5%, 2%. That's unheard of. And you know what? I don't think it can stay that way. If interest rates go up 1%, 1.5%, people aren't going to be able to afford their mortgages. Well, guess what? Thank goodness they did the stress test, because the stress test didn't base their payment on the 2% of the mortgage. It was the rate plus 2% or 5.25%. So a lot of these people that did get into the market had to pass this test, that if rates went up, they would be able to afford to pay it. Now, if you're with a credit union, individual credit unions will choose whether they decide to implement the stress test or not. Okay, it is not a requirement. They are exempt from it, but they can choose to have you do it or not. A mortgage broker, it's great to use a mortgage broker, because a mortgage broker is going to look for you for the best rate out there possible. And it doesn't cost you anything. The mortgage broker is going to find you the financial institution that's going to give you the best interest rate. And the financial institutions pay the mortgage brokers. All right. Down payments. Now, this is really scary, but back when I was lending back in the early 1980s, yeah, I'm getting old. I should be retiring soon. Back in the early 1980s, interest rates were like at 18%, mortgages 12%. People were walking away from their homes. Some financial institutions out there, if somebody didn't have the down payment before then and wanted to get into a home, they'd give them a credit card and say, well, here, put $20,000 on your credit card. That's your down payment. Could you imagine buying a home and then having that much money owing on a credit card that you have to make payments for? No wonder a lot of people walked away from their homes, and a lot of people did have to go bankrupt. Now, so down payment is important. And that's the first thing I say is, when you're looking to buy a home, you need to save money first, so you've got that down payment. Now, if you can put your money into an RRSP, that's fantastic, because you can save and defer the taxes. When you're putting it into your RRSP, you'll be able to withdraw up to $35,000 for the down payment of your home, and you don't have to pay it back for 15 years. So the year after you buy your home, you start paying it back. Sometimes it's $1,000 a year, just over $1,000 a year. So $100 a month, you make sure you put it back into your RRSP, and you're fine. If you don't put that money back in your RRSP, let's say you happen to miss out 1 year, then the government's going to tax you on that $1,100 that you were supposed to pay. They're going to tax you on it. Repossession and foreclosure. So we talked about them being able to take back their collateral if you don't pay their debt. So they have the right to repossess a vehicle or foreclose on a home. And if you are behind and you have made no arrangements, or they can look at your financial situation. Maybe you did have to close a business. Maybe you've been diagnosed with a serious illness and you're not able to work anymore. They'll look at the whole thing. And sometimes it's best If you are looking at foreclosure, if the bank says we're going to have to take your home, it's best that you sell it yourself and pay off your mortgage. It's best for everybody because you're not going to be subject to a whole bunch of legal fees. You get to choose the timing. And as long as the courts know that you are looking for another house and you do have your house listed on the market, then they'll be okay with that as well. A line of credit. A secured line of credit, we hear a lot about what's called a HELOC. And we're hearing a lot in the news about the news are saying to people, a lot of people took out these HELOCs or these home equity line of credits, and they usually run at a variable rate. So just like the mortgage, a lot of people were in variable rate mortgages. The line of credit would also be something. So again, let's say you assume you have $500,000 equity in your home and you want to do renovations, which a lot of people did during COVID. They took out the money out of their home that they made over the last several years, took out a line of credit with the bank, say for $100,000, and used that to renovate their home. That line of credit is secured by the home. Therefore, it qualifies for a very low interest rate, 2%. And you use it as you need it. Well, when you have to make a minimum payment, and sometimes it's the interest only, guess what? Interest just went up. And it's going to continue going up for a bit, which is scary, but it's going to keep going up. So people who have that line of credit and who are paying interest payments only, their payments are increasing $200, $300, sometimes $400, $500 a month, depending on the size of the mortgage. Okay, it's very tempting to have a line of credit, but you have to be so careful because it doesn't mean you're always going to be able to get it paid off. It could just be another debt sitting there. Credit cards. Let's talk about credit cards. So a secured credit card. A secured credit card is where you are going to put a down payment on your card. Let's say you have a poor credit rating and you've been trying to get those credit cards and they say no. So you can go to your financial institution or to Capital One. They have secured credit cards. And what that looks like is that you would give them, let's say $500. They would put it into a savings account or a GIC and lock it. You're giving it as security that if you default on that card, if you default on that card, they're going to cash out your $500 and pay off your credit card and cancel it. It works wonderful to rebuild credit. It works wonderful if you can't get another credit card, or even if you're just trying to pay off a whole bunch of debt and you just want one other card, so you're not going to use all the other ones. You're just going to get a secured credit card. Okay, and that will rebuild credit. Make a month, use it, pay it off, use it, pay it off. That's the best way to increase your credit rating. Even a cup of coffee. Okay, it doesn't have to be a lot. Prepaid credit cards, unsecured credit cards. Unsecured is a regular credit card, and a prepaid credit card would be something that you want to, now with the Visa debit, the Visa MasterCards, there's not a lot of people that use prepaid cards because the debit and the debit Visa and the debit MasterCard used to be that their numbers were flat. It was just like an ATM card. Well, when you have a flat number on top, it would never go into a parking meter, right? It couldn't be used to shop online. So they came up with the debit Visa, debit MasterCard. The numbers are raised, it goes in parking meters, and you can use it online. All right, let's talk about how credit cards are costing, how much they're costing everybody. And back pre-COVID, a lot of people had a lot of debt and a lot of people were struggling. Enter COVID, people either lost their jobs, people didn't have income, or people kept working, but guess what? They had all this extra money. They didn't have to drive anywhere. They didn't go out and get coffee and lunches. And sometimes that can add up to a lot of money. Maybe they even sold a vehicle because they only needed one vehicle. Okay, so people did not spend money as usually they did. A lot of places were closed as well, right? So they saved up a whole bunch of money. Guess what? Everything's open again. Guess what people are doing? Boy, did I ever miss going to that mall. And I'm not talking about me. Did I ever miss going to that mall shopping? Oh, I love going to the keg. Now I can go back to the keg again. It's open. I've got all this money. Well, guess what? Have you been to the keg lately? It's like $80 for one person, $45, $50 for one steak. I used to love the keg, but I'm not spending that kind of money. I used to love going out to a restaurant and having a salad, but I'm not spending $20 for a salad. I'm sorry, but I'm not doing it anymore. But a lot of people are doing it, and they're putting all this money on their credit cards. So let's take a look what happens. $3,000 credit card, interest rate 20%. The monthly payment on your credit card will be 2%. Okay, will always be 2% of your outstanding balance. Therefore, it would be $60. To pay off that debt, yeah, it's going to take you almost 53 years and $15,700. Now, see what happens if we take an extra $40 a month and put that on there. That can be from a meal you're not going out for, or a tank of gas because you decided you're not going to drive very much because of the cost of gas, or $10 a week from not eating out or going to drive-throughs. Just by putting that extra 40 on there, look at the difference. 3.5 years to $4,184 compared to $15,709. Okay, any extra money you have, if you are carrying debt, please put it on there. It makes the world of difference. The faster you can pay off your debt, the more money you're going to save and the better off it's going to be for you. Now, interest on cash advances. That is scary because if you take a cash advance, so let's say your rent is due, you don't have money to pay your rent, but you got money on your credit card. You go to your bank and you say, I'd like to take out a cash advance for $1,000. They give you a cash advance on your credit card, you put it in your bank, your rent clears. Excellent. You get paid, you pay off that cash advance. Fantastic. What if you don't pay off that cash advance? Okay, the interest on the cash advance starts immediately and it's a higher rate. Okay, credit cards are going to allow you to go over your limit. They're going to charge you a high fee. And if you pay your payment late on your credit card, your interest accumulates and it starts at your billing period. So if you don't pay off your credit card every month and you carry that credit card balance of $3,000, that $3,000 starts from day one on your next billing cycle. But if you pay it down by $2,500, you only have $500 left, you're only going to be charged interest on the $500. Okay. Student loans. Student loans are based on a need. Students will have to reapply every year for a student loan. Student loans are fantastic if you need them to further educate yourself. And what that looks like, why do we go to post-secondary schools? To further educate ourselves, to earn more money. That's why we do it. So student loans are a good thing. You have good debt and you have bad debt. Good debt, student loans, mortgages. Bad debt, credit cards, overdrafts. Okay. You can use them. There's no interest until you finish school. Sorry, no interest and no payments until you finish school. A joint and a co-signed credit. A credit is obtained with another borrower. Now, basically, when you're talking about a joint, a guarantor, a first borrower, second borrower, doesn't matter. Okay. We used to have a lot of guarantors. Now we don't. Now a lot of financial institutions are saying, we're just going to write that loan in both names. Because if you don't make that payment and somebody else makes that payment, or if you don't pay it, your co-borrower has to pay it. Your joint person has to pay it. And when you need to borrow money, they also do a credit check on the co-borrower, the joint borrower. Now, what happens if you file bankruptcy? That loan still exists and your joint borrower has to pay for it. Also, one of the big things, or two of the big things, one is if you are getting qualified at a financial institution for a joint loan with somebody else, that joint loan is going to show on their credit report. So if they want to go purchase a vehicle, it's going to show that they're already they've already signed for a loan for a $500 payment because they co-signed for you. So it can stop them from getting more money. It's really, really tricky. The other thing is separation and divorce agreements. Okay, the creditor agreement always stands. It doesn't matter if you separate, you both are responsible for that loan. Okay, if if there's debt that's incurred while you are married, that's considered a joint debt and you're both responsible for it. But if you go out and you decide to take on, because you've got excellent credit, $20,000, $30,000, $40,000 in loans by yourself, and you decide to go shopping and you decide to go on trips, and then you file for divorce, your co-partner is not responsible for that debt because they didn't benefit from it. It didn't go into the house. It was strictly taken out for you. Okay. All right, I'm going to come back to that slide. Short-term or high-term or high interest, the buy now, pay later. I don't know if anybody are using it, but please, please, please be very careful with the buy now, pay later. It may seem like a really good thing, but read the fine print. The people who give you the buy now, pay later, it's like a credit card and it's a secondary lender, which means that a normal credit card, remember we talked about it, 19.99%. Secondary lenders are like Fairstone and Easy Financial. These are lenders that people will go to if they can't get a loan at their financial institution because they've got poor credit. Well, a secondary lender is going to charge you 39, Fairstone 39%, 46% for Easy Financial. So you're going to pay a lot. There's also something out there called a title loan. That is not seen very often, but it is out there. And it's something, again, we have to be really careful with. And what that looks like is if you go buy a car lot from a company and that company, it's one of those fly by the seat of their pants car lots that basically say, oh, okay, you know what? Yeah, we'll loan you this money for your car. It's going to be high interest. And they're going to put a tag on your car. They're going to tag your car and they're going to know where that car is every second of every day. They're going to know because if you owe a payment on the 15th and you are not there on the 15th, guess what? On the 16th, they're going to pick up your car. They're going to take your car away from you because what you are signing when you are taking a loan from them is you are signing to give them ownership. You're signing to transfer that car in their name if you don't pay. Be careful. Don't go to these fly-by-night car lots that say, we can loan you money today. Okay. And a payday loan. Payday loans are 59% interest. Loan sharking is 60%. So loan sharking is illegal. So payday loans can just slide right under there and charge you 59%. Don't ever get a payday loan. If you or anybody else you know is in with payday loans, please have them call us. We can help you get out of them. So when you're looking at 59%, it works out to 15%, $15 every, 15%. So $15 for every 100 you borrow. So if you go to a payday loan and they serve a need, they really do. And so instead of taking out that cash advance on your credit card, your friend says, go to Money Mart, go to Cash Now, or look online. There's somebody there. All you got to do is give them a copy of your pay stub, give them your banking information, and they'll loan you money today. You're thinking, wow, that's perfect. How easy is that? So you go to Money Mart, you do this stuff. And they say, okay, well, here's our charges. And you say, Oh, I needed $1,000. You're only giving me $850. Yeah, we're only giving you $850 because that's the charge, the $150, $15 per $100. Okay. And if you don't pay off that 1,000, or they do take it out of your bank account, so they're going to take 1,000 out of your bank account. Oh, well, guess what? You were sick 3 days and your paycheck wasn't quite enough to cover that $1,000. I've got to go back to Money Mart and borrow more money. It is a vicious cycle and you can't get out of it. It's a red flag for anybody that has gotten into payday loans and can't get out of them. Payday loans don't report to the credit bureau, but if they're delinquent or they go to collections, they definitely report to the credit bureau. Okay. Retail credit. So here, buy now, make no payments for 18 months. Buy now, pay no interest for 12 months. Low introductory interest. Transfer your credit balance to us at a lower rate. A low introductory interest. All these are going to catch your attention if you get mailed an envelope that says, hey, 0% interest for the next 6 months. You've been pre-approved. Number one, you haven't been pre-approved. They don't have a right to check your credit report without your signature. So you're not pre-approved. How do they know? They're sending you this hoping that you've got a whole bunch of debt that you're going to transfer to them. Remember I talked about a cash advance? The pay now, get it now, pay later, don't pay any interest, don't make any payments for the next 6 months, no payments, no interest. If you do not pay off that debt in full at the end of the 6 months, you go back to day one and it's cash advance interest rates, which could be 29% daily on your balance. Okay. Financing places, furniture places will always offer pay nothing down, don't pay for a year and a half, 18 months. If you're going to do something like that, they will charge you an administration fee. Might be $35, might be $50. So there's a cost right up front. Now, of course, they're hoping that you're not going to be able to pay it back in 18 months because look at the money they're going to make on you. The idea here is to make sure that you're taking that amount that you've borrowed, divide it by, say, 18 payments or 17 payments, and let's say it works out to $100 a month. You have two choices. You can pay $100 a month on that debt, or you can transfer $100 to a savings account every month for 18 months. Well, for $3,000, I guess it would be more like, what would that be? Because $100 is only going to give you $1,800. So you're looking at about $150 to give you $3,000. So $150 a month, put it into your savings account. Then on the 17th month, you put that whole lump sum on that debt. A lot of people would do that if interest rates were really high right now, like they were paying the 8-9%. That's what they would do. Put it in a savings account, earn some interest, and then just pay it when they have to. Okay, please be very careful of what you're doing with that. As well as if you're looking at applications that people have, or they tell you you're helping them with their finances. Okay, if they have this, oh, but I don't have to pay that for 18 months. It is still a debt that they owe, and they are still definitely going to have to pay. So here's the purchase, $3,000 worth of furniture, 30% interest over 5 years, no interest, no payments for 18 months. So there's your payment amounts for 18 months. Okay, 167, I said 150. Monthly for 5 years and monthly for 3.5 years. And you start after the 18 months where there was no payment due. Look at how much that $3,000 is costing you, $5,800. The same as if you take it monthly for 5 years. That interest is going back to day one. That's where you're getting the $2,800 in interest. It's calculated on a daily basis. taking a little bit more time with this because I do want to make sure that you do understand how it works. And please, if you have questions, you can put them in the chat, or we'll talk about all of this at the end. So write them down. A secondary lender. So a secondary lender will be somebody who charges high interest, and it may be secured, it may be not secured. So remember I mentioned Easy Financial. Okay, if Easy Financial gives you a loan for $10,000, and this is at an interest rate of 30%. So let's go with Fairstone, because Fairstone's about 29.30, somewhere around there. If it's a 5-year loan, look at what your monthly payment is, $323. That's not bad. I can manage that. Look at how much you're going to pay if you keep that loan over 5 years. Okay, it's going to cost you $9,411 to borrow $10,000. Now, these secondary lenders, that's where they're making all their money. Now, at the same time, they're also going to, actually, I'm going to come back to this because it may be a little bit later slide, but if not, I'm definitely going to come back to it. A title loan, all right, they are, again, more prevalent in the US, but here again, when I was talking about, if you cannot pay the debt back, they will seize your vehicle. Okay, and watch the fine print. Payday loan, this is your Money Mart, this is your cash store, this is anything you see online. And it's an unsecured loan based on your paycheck. They don't need a credit check to see if you're good for it because you're giving them your paycheck as collateral. Yes, they're going to charge you high interest, and it's going to be an automatic withdrawal to come out of your bank account. And you're going to have to provide some paperwork to show that you still bank at that bank. They never used to, and they got taken for a lot of money. It was making it hard to collect their money because they weren't double checking that this bank account is still open. Now, payday loans do fill that need. In case you are short, let's say I use rent or your credit is poor, but talk to your financial institution if anything like that happens. I know Van City has what's called a fair and fast loan, and that's like a payday loan, but you can pay it back monthly. Maybe a small $500 overdraft is all you need to cover you if you're short between paychecks. Interest rate comparison. So the line of credit, 2 to 20% interest. The 2% interest, again, would be a secured debt. Okay, that would be like your home equity line of credit, and it can go all the way up to 20%. A line of credit is normally $5,000 in a financial institution. The overdraft, 21%, that is normally $500 to $4,999. It's just for the small, and 21% only on the amount you use. If you pay it back every payday, let's say you use it for 5 days, you're only going to charge interest on that for 5 days. Okay, it's much better to get that than to go and take out a payday loan. Or worst case scenario, have a check bounce. Then you're looking at fees on both ends, and it's not good. Okay, credit cards, 0 to 40% interest. The 0% interest, some of those you can get that maybe American Express has always had a card that you have to pay off every single month. And if you qualify for like an American Express Gold card or Platinum card, you may have to pay a fee to get that 0% interest, but you may get a whole bunch of points with that card. But that card could also cost you $300 a year in an annual fee. So that's another thing. If we're looking at cards, don't take out credit cards just to get the points and miles. Make sure you check it out to see if you're going to have to pay an annual fee for that. And there's our payday loans. The 17%, which is the $17 per 100, is in Manitoba. The 390% is what 15% works out to. That's an annual percentage rate. That's calculated on a daily balance. Okay. Now, let's go back to Oh, the secondary lender I was going to talk to you about. All right, if you end up going to a secondary lender, or somebody goes to a secondary lender, they're going to need to improve their credit. So what that secondary lender is going to do, and you can find them online right now, so it's not necessarily just a brick and mortar branch that you can walk into. You can borrow the money, then they're going to say to you, oh, do you want to improve your credit rating faster? Why don't we give you an additional loan? We'll extend that one loan that you have. We'll make it a lower payment. We're going to give you an additional loan, or maybe you don't have a big payment for $1,000, $3,000. You make that payment every single month for 6 months, and your credit rating is going to be brand new again. Okay. Everything that reports on your credit report stays there for 6 years. Everything. So there is no way to rebuild that credit in 6 months. Absolutely no way. You can rebuild your credit slowly by making your payments on time, by paying off your debt faster than normal, and by not getting new credit, paying it down. But you do not need another loan that somebody's going to tell you that's going to improve your credit for 6 months. So if anybody that you're looking at has loans with Easy Financial or any of these, be really careful. And Alpine Credit, we see a lot of people going to Alpine Credit, or what's the other one? Alpine Credit, and the song's going on in my mind because we see it on TV all the time. Call 1-800, maybe that's Alpine Credit, I can't remember. Capital Direct, that's it. So these are secondary lenders pretty much for mortgages. So if somebody comes into a financial institution and says, I need to consolidate my debt, I've got $100,000 worth of debt. And we look, yeah, you've got $500,000 in equity in your home too. But you just remember that capacity. You don't have the capacity to pay another payment. I'm sorry, there's nothing we can help you with. However, try Alpine Credit, try Capital Direct. Okay, these are two that you have to be very careful with. Again, they are a secondary lender. They are going to charge you 10, 11%. It may even be more now that interest rates are going up. For a mortgage, yes, that's $100,000. So they're going to give you that. They're going to register it against your house. You have 1 year with them before they're going to want your money back. It's usually one year. They're going to send it back to your financial institution and say, okay, can you pay it off now? Some of them might extend it a little bit. Some of them might not. And you could be left in a real bind. You're paying high fees, you're paying high interest rates, and you could end up paying court costs. All right, so final thoughts. We need to really think about what we can afford. When we're talking about what we use credit for, we use credit for things that we want. We use credit for things that we need. But now we really need to look at it and say, can we really afford? Not I need this product, not I just want it. Can I afford it? Okay. Try it on for size. Save the payment amount for 6 months and see if you can do it. So my son who wanted that $80,000 truck, what's his payment going to be? What, $1,500 a month? Okay. You want that truck, put $1,500 a month right now, give it to me every month. Okay. He's going to go, I can't do that. Well, yeah, you can't afford the truck either. Same with buying a mortgage. If you think you can afford the mortgage payment, save it for 6 months, along with paying everything else. A lot of people that look at mortgages, if you want to get pre-approved for a mortgage, they're looking to see the bank's going to qualify you on your gross income and your housing payments. not your other debt, not the fact that your kids are in sports and costing you $500 a month, not the fact that perhaps maybe you smoke or drink. Maybe that's $500 a month. What about the fact that maybe you're sending money home to family? That's got to come first. So it's not just the housing, it's everything else. Pay off your debt in the shortest amount of time and add extra payments if you can. And even nowadays, if we're not going out there with the flu season, I try to stay home as much as I can. I work from home. I love it. I don't have to go out there and drive too much. I don't go to the malls. I don't want to go shopping. There's a lot of people, we talked about that a little bit at the beginning. There's a bad cold going around up there and it's hitting some people really hard and kids really hard. So I just like to stay home and just, stay away from that. And the more you can stay home, the more you're going to save money, because we do spend a lot of money on convenience. Whether you're going through a drive-through for a coffee, for a meal, whether, oh, these people are having a sale, I'm just going to go to the mall today. Okay. So now my hope is that you're able to describe what creditors look at to make their decisions, the difference between a secured and an unsecured credit, and that you understand the various financing options available to you. Make minimum payments gets us nowhere fast. Pay your minimum payments. In order to keep your credit squeaky clean, you need to make your minimum payment on time every month. That will report as a 1. Read the fine print on any contracts. Ask to take it home and think about it before you make that decision. Can you save for the expense instead of borrowing it? And check out our website. We've got a ton of resources on all this information and then some on My Money Coach. Got budgeting information. That's fantastic as well. Food and finance. We've got 75 ways to save on household expenses. A lot of information out there. We offer 15 free public webinars a month. You can check us out on social media. And I'm just going to, I'll leave this up on the screen just for a moment if you need the phone number or you want to message us. If you just have a quick question, you can message us through online chat, or you can even ask it now. And I will come back to that. And credit reporting agencies. Check your credit report. Make sure what's on there is right. You can check your credit report once a year for free. You're going to want to check it with Equifax and you're going to want to check it with TransUnion, one of each. Some creditors will report to Equifax and some will report to TransUnion. Many, many years ago, God, I'm really sounding old. Many years ago, there used to be only one, and it used to be only Equifax. So you only ever had to check the one. Now you have a whole bunch of these different financing companies that are coming up, cell phone companies, a whole bunch of different things coming up. They might choose to report only to one of them. So if they report just to TransUnion and you get a copy of your Equifax report and you go, oh, my debt's not on there. Maybe I don't owe that debt. Guess what? Yeah, you probably still owe it, but we want you to check both of them. Okay, once a year for free. Maybe check one in January, one in July. You don't really have to check it every year. You can just check it, every 2 years if you want. Okay, now the other thing, free consultation page. Yes, exactly. So I will put these, I will leave a couple of screens on here and I will come back to them. Maybe I'll leave this one on for 5 minutes. We'll answer some questions and then I'll move over to the credit reporting agencies. And then I'm going to stop for a few minutes and ask you all if you could please fill out a survey for me. All right, it's really important to myself and the society that we get your opinion, as well as Manuel would like the feedback, I'm sure. Are there any more sessions that perhaps Manuel thinks that would really help you? Right, so let's talk. Anybody want to start? You can put your questions in the chat, or you can go ahead and unmute yourself, put your hand up. You check your credit report weekly through borrow well. Wondering if that's okay. Um, you can, but don't infatuate yourself. Worry a lot, waste a lot of time doing it. My son used to check when he was home, and he would order skip the dishes, and he'd eat his food, and then he'd pay off his credit card. And then he'd go, how come my credit rating went down, Mom? Or how come my credit rating went up 2 points? I finally said to him, don't pay any attention to that, because your credit score is based on, oh, sorry, I didn't know I had this light in my face from my blinds. Your credit score is based from what's being reported to them. So if you have a credit card and it only reports once a month, it's not going to change anything. Okay, so please don't over infatuate yourself with your credit score. Okay, I have another question in the chat. Oh, okay, Angel has to hop out. Should I wait for the survey? No, Angel, that's okay. What I'm going to do, Manuel, is it okay if I send you the survey by email as well, and you can send it out to the group?
Yes, I will include the link to the recording. I will include the slides as well as the survey, if that's okay.
Perfect. Yes,
So,
absolutely.
and if I'm okay, I would like to, share a few observations through,
Yes.
that I have some notes here. So let's talk about the difference between lenders and developmental lenders. When I talk about traditional lenders, we are talking about RBC, CIBC, Interior Savings, all those traditional lenders. So, and there are developmental lenders such as BDC, Futurepreneur, Van City, as well as RISE, as well as community features. So developmental lenders will be in the position to take, or to review a little high risk loan application. So when you are bankable, so usually if for the traditional banks, it's going to be if your FICO score is 650. If you score below, you are considered not bankable, and they will be referring you to a developmental lender. So the developmental lenders, such as community features, will be looking into what type of benefits they are going to be experiencing in your community if they approve the loan. For example, if you have a loan application to start a business, and I will see, okay, is this business going to provide a service or a product that is not currently available in our community? Is this loan, by approving this loan, there is going to be a job creation? Those are the aspects that a developmental lender is going to take into consideration. So versus the traditional lenders. Traditional lenders, okay, yeah, if you have a good credit rating, you most likely will be able to secure some funding with them. So I also want to talk about the credit scores that Anita mentioned. So she said like from 300 to 900. So I was a lender for the past 10 years, and I never saw a credit score of 300, which I know it's there, but the lowest score I saw, it was 450, which is bad. It's really bad, and it takes a while to be able to build up. And the highest credit score I saw, it was 860, and only for one, I run so many credit checks, and only one person in 10 years scored 865 actually. So that is something for you to keep in consideration, right? Also, keep in mind that the average debt for a regular Canadian, it's around $45,000, which is high, without mortgage, and with mortgage it's around 75,000. That is a lot. That is crazy. So I want also to mention that CRA is a preferred creditor. So if there are, once you do your income tax, if there are any money owing to them, and if you have not put a repayment plan in place, they can go after everything. Like even if you're making a payment to your credit card or to your mortgage or to any loan card, so they will say, oh, this client owes me money, and I see that she or he has been making payments to you. They try to say, okay, I want that money for me because I am a preferred creditor. So keep in mind those things as well. When you're looking for mortgages, so it's okay to go to one or more banks within a specific period of time, so that it's only one hard hit. So, and that is specifically only for mortgages. So people say it's 3 weeks. I would be safe to say 2 weeks, 15 days. If you are going to be shopping for another mortgage, make sure that all the credit checks happen within the 2 weeks, so that they are going to be reporting only one hard hit instead of 5, if that are the numbers of banks that you will be approaching. One thing also that I want to mention is the personal line of credit or personal loan versus a business loan. If you are trying to raise money for your business, and if you approach a bank for a personal line of credit, so a business plan is not needed. The moment that you mention, okay, this is a personal, this is a business loan, a commercial loan, so you have to prove the bank that you know what you are getting into by a way of a business plan. And once they review the business plan, they also want to learn more about your financials. So because they want to see how much money you need to make a living. And that money will need to be reflected in your financial projections for the business. How much money are you expecting to pay to yourself? Things like that. I always have the questions from my clients, why they are looking into my personal finances. Because in order to approve a loan, they have to understand that you are able to, incur into more debt, and you are able to pay that new debt as well as your personal expenses. One more thing that I want to mention, that there are so many clients that they feel that, oh, I'm going to be incorporating my business because I do not want to be personally liable for any debt that I might incur or my business may incur, and that's okay. So keep in mind that any traditional lender is going to request a 2-year financial statement. So if you are incorporating a new business, it's going to be a brand new incorporation. You are creating a different entity for the business. Then you are going to not to meet that requirement, because you won't be able to provide the 2-year financial statement. So they will ask you to sign a personal guarantee, meaning that if the corporation is unable to repay, so you will be responsible for the loan. So that is kind of like, okay, just it can defeat the purpose, something for you to keep in mind. Also, regarding credit cards, remember there is a grace period. So usually it's 21 days. So if you repay any debt with your credit cards within the grace period, it's fine. But like Anita said, that is not going to help you to build up your credit rating. So if I purchase something in my credit card and I go back and pay it as soon as I get home, so that is not going to help you. So until it's reported, then you can pay it right away. So that is going to help you in your credit score. What else I have here? Well, my final thought is that I personally use a budget. I have to budget everything. So I have an Excel spreadsheet. If I'm gonna, instead of using the credit card, I will say, okay, I started saving for Christmas back in January 2022. So I started saving for a vacation back in. It's not doesn't have to be, oh, Manuel, I don't have that position to be saving 200 or more. Even if it's $20, every paycheck, or if it's $10 every paycheck, so you can save it, right? So a vacation fund, a Christmas fund, you can create all those savings accounts. If you are banking with any of your traditional banks, they will be able to open those savings accounts for free and start saving. So if you have to pay your if you are have a house and you have to pay your taxes, property taxes, start saving that one in time, so that you don't have to get to the part that, oh, I need that money, I need to run and get a loan right now. So we are living difficult times. The prime right now, the current prime is 5.95. So if you are trying to borrow money, so that's going to be prime plus 4 or prime for 5, depending on the situation. So just in summary, when I deal with my clients and they are trying to raise capital for the business, my goal is to determine the minimum amount required. That the minimum, the less the business get into debt, the faster the business is going to recover. That's something for you to keep in mind. So if you are able to run the business without any financing, if that is possible, it's better. But sometimes we have to apply for some funding, so we have to determine the minimum amount. And maybe you can have phase 1 and phase 2, so that for your dream scenario can be the phase 2. Okay, thank you, Anita.
Thank you, Manuel, for all of that. I just wanted to say two things before we talk again. Is Manuel, you reminded me of something you were talking about, paying off your credit card. That's what I was going to say with my son as well when he ordered skip the dishes and he checked his credit rating. He also would pay off his credit card right away. And I told him, don't do that. Don't do that. You have to wait till you get the statement. Then the statement balance is reported to the credit bureau, and then you pay it off right away. And don't wait till the 21 days. You've got the money in your bank. Hopefully you're going to pay it when you get the statement. The other thing is with the savings for property taxes and things like that. We talk a lot about that in our budgeting course. And when I started working in the credit union system, it was 1979. And when I worked back then, we had everybody that had savings accounts. You had sometimes 5 savings accounts. You had one for property taxes. You had one for car insurance. You had one for Christmas. You had one for vacation. And every payday, we would move so much money over so that they had it. Because when things, we called it irregular expenses, that's what they are. You know they're going to come up throughout the year. So you need to be prepared for them because you know how much they're going to be. How many people know that if they celebrate Christmas, it's next month? How many people have saved for it? Probably not a lot. They're going to go use their credit card. All right. Thank you, Manuel.
Excuse me, can I ask a question?
Yes, you sure can.
Thank you. It's about the business, the startup, the small business that I want to start up, and the problem is that I don't work here, but I have an excellent credit score, and my money is a good enough money that monthly transfer from overseas to me to Canada by my husband. So since that I don't work here, I'm wondering that if I can borrow money for, just for starting up my business from I don't know where, from which financial institution, any lender who can where I can go and get help from.
You'll always want to start at your financial institution.
Yes.
Always
No.
start. Sorry, go
Okay.
ahead.
Yeah, go ahead, please, ma'am. Thank you.
I was just going to say, you always want to start at your financial institution, and they will let you know what they can do for you. And if they can't, they will recommend you to go somewhere. Manuel, maybe you can key in on this if you know anything about this.
I was going to ask her, what's your status here? So are you permanent residents? Are you a citizen, or are you visitor?
I'm citizen.
Okay, so yeah, you should not have any problem. So what I do with my clients, I just do a quick review of their credit score to understand, or credit report to understand what are your options to get credit. And once we determine that one, we discuss what is going to be the best lender, the right lender for you to do that. So feel free to send me an email, and we're all happy to help you on that.
Would be great. Excuse me, just Manuel, I don't have your information, your contact information. Can you provide for me one more time?
Yeah,
contact information.
I have typed my contact information in the chat box, so everyone can have it there.
Perfect. Thank you very much.
You're welcome.
Thank you. I'm just going to answer a few questions in the chat here. Do I need to clear up my credit cards before I start to go to lenders for a business loan? You don't necessarily have to clean them up. It depends what you've got owing on them. But if you're going for a business loan, they'll let you know if they want you to clear them up or not before they can approve it. Will accepting or applying for a first-time credit line help my credit enough to risk the interest rates? If I don't need the loan and could pay it off right away, I keep getting pre-approved amount for amounts I could pay up cash for, but I'm not sure if this would be beneficial or just be unnecessary. Okay, Chelsea, so just a couple of things with that. If you have credit already, and if you're managing it fine, then you don't need to apply for anything else. All we need to get good credit is one credit product. When you're pre-approved, remember that they are going to require a credit check. So that's going to look like you're applying for new credit. Okay, so if you don't need it, then no, don't do it. Does that answer your question?
Yeah, I'm just like young, but still building my credit to some extent.
Yeah.
So yeah, I was just wondering if that was,
if you have the credit, if you have credit right now, like a credit card or overdraft or anything like that, and you're paying it every month, then no, you don't need more credit.
Okay, perfect. Thank you.
Okay, you're welcome.
And I just want to answer the question for Charmian. Please, could you explain the RISE loan a little bit more? So I work with RISE. RISE, it's a charitable, actually, no, it's a society across Canada that has loan programs from $500 to $10,000 for people who are recovering from any type of addiction. So they do loans, and they are really fast to reply to a loan. So sometimes when my clients need some money and I feel like they meet the requirements, so I go with RISE, and they are comfortable, with unsecured loans for $5,000. And sometimes they go to $10,000, but they are more comfortable below the $5,000. And these are only for businesses. So if you need a loan, for example, I need to meet payroll for the month and I didn't have the revenue that I was expecting, then you can go to them. Or I have a good business idea and we have helped you develop the business plan. And now we have determined that the minimum amount required to start this business, let's say the $4,000, then we can connect you with RISE, and they will be reviewing the loan application. I am as involved as the client needs to be or wants me to be. So if the client said, oh, Manuel, can you please be there in the meetings because I need to talk about financials, that I am behind that part, I am happy to support you. If you will, no, I just want you to help me with the loan application and that's all, then I help you with the loan application, and after that you are on your own. But that's the RISE. I hope I answered your question, Charmaine.
Yes, if I could just ask you, you said it's for people with addictions. Is it only for people with addictions?
Yes, that is mainly. So they have made a few exceptions for my clients when they have a disability or a chronic health condition, but that is going to be up to them to decide that.
Okay. Okay.
Yes.
Thank you.
You're welcome.
And Sean, how are people on PWD assistance going to get a loan to start a business, and does RISE work with the banks? I'm not familiar. I am a little bit familiar with RISE. Little bit. People on PWD assistance, maybe Manuel, you can help with that.
Yes. So personal disabilities. If a client is receiving personal disability benefits, so we have to pretty much make it clear, or I need to, as a business advisor, I need to understand if my client is trying to be off those benefits or they are trying to supplement those benefits, because there is only an amount that they are allowed to make per year. So if my client says, oh, I need to supplement the benefits, so I need to find out, in writing from the ministry how much my client is able to make. So we are going to be working on a business plan that is not going to jeopardize those benefits, because we want to keep them and we only want to supplement them. So the Community Features Program has a fund that is called Disability Benefits Fund. So if you live in a rural community, we can help you submit an application to your local community features. Community features, it's different from banks. So we received this federal money a few years back, maybe 25, almost 30 years ago. We received a loan. Every office in across BC receive a certain amount of money, and that's the only money that they receive. They are supposed to manage and administer that money, because once the money is gone, it's gone. So they need to review the application and decide if you have a solid business idea, so that they can help you with the funds to start your business. So again, we are talking about a business loan that the local community features can help you. If you have a disability, I work with other organizations. So if you are turned down by the local community features, I have other lenders that may be able to help you. But again, every situation is different. I will have to review where you are. Again, to talk about your personal finances, talk about your idea of starting or already operating a business, to decide what is your best option. Any other question here? Okay. The other question is about, is there a loan cap amount for community features loans for business startup? Yes. I would say yes and no. So every community features has a limit of $150,000, from $500 to $150,000. So I have to mention that not all the community features office have money for people with disabilities, because they may have already run out of that money. So you will have to contact your local community features office to see if they have a specific money for people with disabilities that you can apply it for a business loan. So the other regular pool of money that they have is 150, and in some situations when the client needs to raise more than 150, there can be a partnership between more than one community features to be able to raise additional money.
Thank you, Manuel. I'm learning a lot here today as well. This is fantastic.
Okay, so what other questions? So I'm not sure about because my startup costs are sitting at 16,500. I'm not sure what he meant.
That's the same. That was Sean who asked if people on PWD assistance can get a loan. Does RISE work with the banks? And because he's got a startup costs of 16,500.
Yeah, again, I will have to review the situation because RISE can be in the position to, let's say, provide $5,000, and we can have some bridge financing with a different lender to be able to raise the 16,500. My responsibility would be to determine if the 16,500 is what it's needed. My goal is for my client not to be overfunded or underfunded. So we have to justify that 16,500 is the minimum amount required. And then once we determine that one, we can move forward. But in many cases, I am able to make it work with less money. That would be the goal. And to answer the next question, the best way to contact me is by email. I have already posted my email here. Now, Darren, you have a question here.
Well, I'm kind of afraid to ask it because it seems almost kind of silly, actually.
No question is silly.
Okay, well, I just wanted to ask, like, with financial advisors that provide excellent financial advice, such as yourself, Anita, and I'm just wondering and I know this seems off topic here, but when people in the financial industry ever experience hard times with financial challenges, do they immediately know what to do if problems arise for themselves? Like, I mean, this advice you're giving is great, but I mean, how do you, you don't have to answer this if you don't want to. How do they know what to do that's probably common sense of what they recommend other people should not do?
They should, a lot of people who work in financial institutions go through training. We have to take courses. I've got an accredited financial credit counselor of Canada designation that I have to do my CEUs every year, as well as my personal education finance. I have to do CEUs. We take a lot of webinars. We do a lot of podcasts. We educate ourselves. We are educating ourselves all the time. And that's how I learned all this when I started at the financial institution, is you learn from people that are with you. And even if you're starting and you're new, Darren, that's a great question. But if I didn't know how to help somebody, then I would ask a coworker. And then all the information that I'm given, I try and retain it. So we have to remember that if they don't know about the resources that are out there, that are available to the consumers and to their clients, that's where they might run into a little bit of difficulty. Now, you may have a lot more resources than they do because they're just with their financial institution. Does that help you a little bit?
Yeah, sorry. I almost wish I didn't even ask the question.
No, that's okay. That's okay. And personally, I find that credit unions, especially somebody like Van City Credit Union, they do a lot of this education for people, and they're fantastic with educating people on. They have their own budgeting program. So don't feel bad asking.
Okay.
Thanks.
And Anita, can you stop sharing your screen so that I can share something to answer the next question?
Absolutely.
So the question says, any grants for a startup business for these people with disabilities? So I just want to touch on that. So let's talk about grants. The only link that I will recommend is going to be Industry Canada, and I want to share my screen. So I want to go to Industry Canada website right now. So can everyone see the screen? Yeah. Okay. Yeah. So we are in Industry Canada. Yes. If we scroll down, we are going to find here Business Grants and Financing. We click this one, Business Grants and Financing, and I can send you the link as well. And there is another link here, Grants, Contributions, and Other Financial Assistance. So we are going to click there. Now, these are all the grants available across Canada. So we have to filter them, and we are going to click any grants available for British Columbia only. And there are other filters that you can apply here. So, after that, we are going to say apply filters. So now it's going to produce there is 99 grants available for different areas. So once you go here, let's check the first one. You click here, and it's going to give you information about the requirements, about as well how much money you can apply it for. So this website changes a lot. So I recommend my clients to check it at least every other week to see if they have, announced something else. Sometimes they just put it there and they have not even make an official announcement. So if there is any grant that you feel it's applicable, then through my program, you can approach me and I can help you. I mean, if you are having, okay, I should mention, if you are having or experiencing a mental or physical disability or a chronic health condition, then you are eligible for my program. So, and through my program, I have grants specialists that they can help you review. You will have to come up with the application, and we are going to be reviewing for you. We are trying to maximize your chances to get approved for any of these grants available. If you scroll down, it's going to give you the option click more, and it's going to display more grants available. So again, as of today, there are 99 grants available, and you will have to spend some time to review those grants, and I will put the link right now as well here. And I hope that answered your question.
This is fantastic. And Darren, going back to when I say about educating ourselves, I didn't know about this website. Thank you, Manuel, for sharing it, because this is fantastic for me to know as well. So like I said, every day we learn something new, and we always want to pass that education and the tools onto you.
And I have pasted the link right now, and everyone has the link. So I don't see any other questions. Do you, Anita?
No, I don't actually. I think we've got them all.
So if you have any other questions, so feel free to contact Anita or myself, depending on the question that you need assistance with. And other than that, thank you so much for attending this webinar. We really hope that you learned something. I myself learned something, and I feel good about it. So thank you so much for the time. Have a great day, and I will be providing the information by email to all of you.
Yes. Thank you so much, everybody.
Thank you.
Have a great day.
Thank you.
You're very welcome.
Thank you very
Bye.
much.
Bye-bye.
Goodbye.